Better System Trader, Episode 17.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 17 and I'm your host, Andrew Swanscott. I'm sure we've all heard the story of the turtle traders, the legendary trading experiment conducted by Richard Dennis and William Eckhart in the 1980s to see where the great traders were born or could be made, producing over $100 million in profits. Well, today's guest started his trading career in 1983 as one of the original turtle traders and has been the most successful. He's now the chairman and CEO of Chesapeake Capital, a global investment manager that provides investment and portfolio management services to both private and institutional investors worldwide. He's been trading a similar style for over 30 years now, so has loads of knowledge and experience to share with us today. In this week's episode, we talk about trend following, how to approach wins and losses, dealing with drawdowns, managing correlations in asset classes, and how changing market dynamics have impacted trend following and the solution. He also gives us some tips on systematic trading, including how he trades without relying on optimal values of the past. Now, I also have to warn you that there are a few brief periods during the interview where the sound quality gets a little poor, but do hang in there because the audio comes good again and you don't want to miss what he has to share with us. So let's get right into it. Today's guest is Jerry Parker. I hope you enjoy it. Hi, Jerry. Thanks for joining us today. Now, I'm sure everyone has heard the legendary story of the turtle trading group that Richard Dennis and William Eckhart started back in the 1980s. But just as a refresher, could you give us a little bit of background on how that got started and how you got introduced to the world of trading?
Well, I read an ad in the Wall Street Journal in the fall of 1983 from Richard Dennis, who wanted to start a training program to train traders how to trade and stake them with his own money. And I was obviously intrigued and decided to answer the ad. I think it's a little fortunate because I'm not sure if I really read the Wall Street Journal 1 ads very often, and certainly thousands of people, according to them, applied in 1983 and 1984. So I was very happy to see it and apply and eventually get an interview in Chicago.
Okay, so you said thousands of people applied. Obviously, only a small number of people got selected. What do you think the qualities they were looking for in the traders that when they first started that program?
I think they wanted people who were above average intelligence, and think they wanted people who were open-minded and could be taught and maybe hadn't learned too much and had too many bad habits. So I think also when you sent your resume in, they sent back a true-false test, and that gave them a sort of an indication of how you thought about markets and life in general, and then also how much you already knew about trading and possibly trend following. So I think I did pretty well on that initial true-false test. And they wanted to hire people who had done well on the test, and they also wanted to hire people who had not done well on the test, but who had other things going for them. So as just a small time young 25-year-old in Richmond, Virginia, in an accounting job, I needed something other than my experience or good looks. So I think I did pretty well on that test.
So do you think there were some qualities in your previous accounting role that transferred over or that they saw could transfer over into trading?
I don't think so. I think what they basically saw was in the interview, I was very passionate and about becoming a trader. And nothing was going to stop me from being a trader. And I think that's what Rich told me later on was what impressed them, that my passion. I thought I knew a lot about trading, and I really didn't. Of course, they asked a few of us, at least in that interview, how much we knew about trading already, from 0 to 100, how much do you know? And I probably said something like 90%. and which, looking back on it, it's kind of a joke. I don't even know. I don't even know 90% now. So, compared to what they knew and what they ended up teaching us, these were the greatest mentors and the smartest men I'd ever met. And it remains true today that Turtles had a instruction and tutoring and in an environment that was above all, and it could not have been better training on how to trade and then how to evolve over time and continue to create systematic trading approaches that would sort of stand the test of time. A lot of what gets lost in the Turtle story is the actual here's where we buy, here's where we sell, here are the techniques that we learn. But we were in an incredible environment, amazing mentors and teachers and these incredibly smart people, plus an environment of that we were just encouraged to do the right thing. And if you were losing money, but you were doing the right thing, that's fine. And in fact, if you're losing money, we may give you more money. But if you're making money and kind of not doing what you should be doing, you may get in a little bit of trouble. So it was just the perfect environment to start. It's the opposite today, where a small drawdown will create all kinds of angst amongst clients and employees and friends and whoever. And so in that particular environment, it was just amazing, the level of encouragement and the requirement basically just to do the right thing, trade correctly, and don't worry about performance to a large degree.
Right. Okay. So, what were some of the traits that were common among the most successful of the Turtles?
Well, following the rules, of course, was the top trait. There were some people maybe in the turtle trading class who had a hard time with that and maybe thought that we weren't, if we had a small drawdown or a big drawdown even, obviously we weren't rich, and Rich didn't tell us all of the secrets. And so it just, some people are just not going to be able to trust and do the right trades, and they just can't do it. And no matter how smart you are, sometimes you just have that a bit of doubt. And so thankfully I came from a situation where I didn't have a lot going on, and I had a great opportunity, and I just looked at it as, how crazy would it be just to blow this opportunity and not just put all my faith and trust in these guys and in their training. So I think that was certainly, that's the most important thing, is following the rules and being willing to submit yourself to the wisdom of others.
So, what did you find was the hardest part when trading as a turtle?
Well, I guess in my entire life, I've sort of been a notoriously slow starter. So one of the big rules coming out of the trading class was trade, do the trades. You cannot miss a good trade. Don't miss a big trend. And if the system says do a trade, you should just do it. So maybe the first week of trading, I got a call and Rich asked me, like, how many trades did you do this week? And I was like, well, probably like about 5. And he said, well, how many do you think you should have done? I said, probably about 20. And he was like, yeah. He was just like really low key and the nicest person. And, he was just like, yeah, that's right. Just do the trades and don't worry about it. And, that's sort of the key, is you've got to do those entries. So the type 2 era of missing a trade that you should have taken is far worse than take a type 1 era where you take a trade and you shouldn't have taken, because in hindsight you only know you shouldn't have taken it. And then number 2 is you have your stop loss that's going to ensure you having a small loss of your portfolio's capital to bail you out if you obviously on the bad trades. But nothing's going to bail you out if you miss a big huge trend, as trend following, the way we practice it, was dependent upon a small percentage of your trades making all of the money.
Right. So, how did you personally overcome that issue of not taking all the trades?
My performance was probably one of the worst in the room, and I had a lot of tough love, and I realized that I either was going to do what I was supposed to do or I was going to fail. And so the fear of failure sobered me up pretty quickly.
Okay, and what do you think was the biggest lesson or the biggest thing you learned overall in your time as a turtle?
Well, I would say, of course, the trend following philosophy, and then the markets are hard, and what works in the markets is not going to feel good and is not going to be particularly emotionally rewarding. Another great characteristic of the turtles was a very healthy skepticism of others, of clients, of people who would try to tempt you into taking shortcuts in your trading and not utilizing the most robust methods. So I think just an independence that you're not going to get a lot of positive feedback, and you shouldn't desire people's approval of your trades. It's a lonely business, and it's a difficult business. But doing the right thing, do the hard thing, sort of life lessons um, that also pertain to trading.
Okay, so you mentioned clients there, so perhaps we'll move on a little bit from the turtle program. So when that program finished up, what did you do next?
Well, I moved to Richmond, and I started my Chesapeake Capital. Um, I was very happy trading a million or two of Richard Dennis's capital, but and of course we had no idea that our business would grow and the industry would grow, and at one point we were managing over $2 billion. So we, yeah, went out, and one of the great assets I had in 1988 was a track record, and it was a track record that people believed, and it was a good track record, although our volatility and drawdowns were extremely high because trading for Richard Dennis was not, once again, a real world experience. He wanted us to trade to sort of attempt to make 100% a year versus when I started Chesapeake, I immediately sort of reduced my leverage to attempt to make about 20% a year.
Okay, so when you started Chesapeake, how did the freedom to do your own impact what you did? Like, were there any improvements or tweaks that you made over what you were doing with the turtles?
Yeah, I think the turtle environment was limiting in the sense that we we're all in the same room, and I think it stunted our creativity, or at least it stunted my creativity some. I think I sort of thought that sticking with the group and not being too bold and different was a safer. I think Rich preferred us to add value to what he had taught us with our experience, with our ideas, and give them some nuggets of our wisdom. And if that was even possible from me, it didn't occur. I just sort of felt like inside that room, don't stray too far from what you're already doing, what everyone else is doing. So at Chesapeake, it was a whole new world, and there was nobody constraining us or keeping us in line except our conscience. So I did do some different things and change slightly um, initially and over the years, but I would definitely say that I stick to the basic framework as much as possible because I've not found anything any better. I would change in a heartbeat, and I've gone down a lot of bad paths that didn't prove to be fruitful. But the basic turtle trading, money management in particular, I just have never, I've talked to a lot of traders and I've read books and articles, and I've, think I know what some other ideas are, but I have never found anything better than what I was taught. Now, of course, I've tweaked the parameters and become more long term since the turtle years. We were very short term, and short term trend following, the way that I understand it, have not found that to be profitable.
Okay, so I guess as well that at the turtles you were managing money for a trader who really understood the philosophy and characteristics of the system. So how did things change when you started managing other people's money? What impact did they have on you?
Well, I think that clients always have an impact, and you need to insulate yourself from that impact usually, because it's not usually going to They're not clamoring for, don't worry about losing money, just keep doing the right thing. It's the opposite. It's why did you stay in that boon trade so long, or why are you still, short a market? You're giving back too much of my profit. So, like I said, I think the turtles came out of there with a chip on their shoulder, realizing that uh, we were sort of in charge of doing the system, that all the other outside influences would probably be negative. Um, so I think just having that in the back of your mind all the time made you want to stick to the system even more, since you knew what was coming, usually from people who weren't professional traders, even though they pretended to be.
Okay. Well, if we can just talk a little bit more about trend following. So you mentioned that you moved to a longer term trend following model, but what do you think the most important factors are to making trend following actually work?
Well, that's a good question. I think, of course, diversification is sort of a key. Currencies, commodities, stocks, and interest rates, long and short. I think short trades are very important, and they're not very profitable, but they help diversify your returns. And sometimes they are profitable, of course. Now is a good example.
Mm.
So that's a very important part of trading. Preserving capital, trading small, longer term is better. I think that's difficult to do, and part of trading, successful trading, is to put yourself in a situation where you're doing things different from others and not trying to be like other people, and sitting through sort of like not fun drawdowns like we do. I think has a tendency to keep our methods sort of fresh and not something that other people are too interested in copying. So I think
Mm.
long term is best, and long term is the least tolerable way for most people to trade.
Right. And how do you manage the correlation between asset classes?
Well, I pretty much assume that everything with inside an asset class is pretty correlated. So I allocate 25% of my risk budget to each of the four major asset classes. And then even then, I think sometimes we've experienced situations where those four asset classes, currencies, commodities, stocks, interest rates, they can all be very correlated. So during some periods, you need to be ready to reduce your vol, reduce your positions, trade smaller to preserve capital during those periods when the correlations are increasing. And then, then without notice, the correlations will go back to being less, and you have to readjust. So I don't believe in a permanent or rule, other than the rule saying, hey, it's really volatile here. It looks like I have on one trade. I'm uncomfortable with these losses. I'm uncomfortable with this volatility. So I'm going to trade smaller across the board and ride it out. I don't believe in predicting or doing too much more than that as far as planning for correlation.
Are there any other circumstances where you may look to rebalance positions?
Well, I'm not really rebalancing as much as I'm reducing every position the same amount, 10%, 20% cutback. When I'm in a drawdown or losing money faster than or more than I think is warranted, or, so I think that's the best rule. It's really the only rule that's always going to work. When you're losing money, trade smaller. If you're down 10%, and that's a drawdown that you're not happy with in the circumstances, then reduce your positions by 20%. So have a very draconian rule that prevents you and lessens the chances of hitting another drawdown, 20%, for instance, that would really make you uncomfortable. So it works, it always works, and it's the only thing that works versus more subjective rules.
Yeah, right. So earlier you mentioned that you trade longer term. When you say that, are you just talking about the exits, or are there other aspects to a trading strategy that you can adjust to make it longer term?
Well, my philosophy is to just be very extreme when it comes to the trend. And on the entries, I want to see a strong trend and not a wimpy breakout, but something that's showing a lot of strength near the breakouts. But yeah, you're right. It's if you want to trade long term, you have to have your exits be sort of far away from the market, not too close. I think that's a problem is that if you're following trends and you kind of want to make that money, and if you trade too short term, you have to get right back in order to not miss the trend. Um, and the markets are choppier, so 300, 400 day moving average that keeps you in trades for 6 months or a year if the trend warrants it, and the average win versus the average loss is very healthy. Look, the bottom line is who wants to have that drawdown in that particular trade and give back a third of the profit, even though it would have made more money? So I think that's the dilemma. Are you willing to do what's right, make the most amount of money, maximize the profit on each individual trade, even if it's going to make you feel bad at the end? And I don't think many people are willing to do that. I mean, I think that's what we do. And we go around and we talk to other traders and we talk to clients and potential clients, and it's not very many people out there who embrace their drawdowns if it's part of a superior trading methodology.
Now, managing drawdowns is very difficult for traders. Do you have any tips for how to cope with those periods of underperformance?
Well, it might not be underperformance. It's just a psychological blow to have a lot of profit built up in a trade and to see a third or half of it go away. I would just say the most important thing is to embrace the systematic approach and really believe that you don't know where the markets are going. There's no way to predict. And there's just going to be some really fun at the end. And you're going to be much happier at the end if you just totally 100% embrace systematic trading and following your system and understanding that if you follow the system, that's the right or wrong, not giving the money back or taking a loss. You weren't wrong if you took a loss. You weren't right if you made money. You just followed the system. So to the degree that you follow the system, that's how you're going to earn your grade, an A, a B, or an F. And unfortunately, in trend following, if you miss a trade, one trade, two trades a year, more than likely there'll be a couple of really big winners that that will going to materially impact your performance. So sell your soul, sell out to the trend and a systematic trading, realizing that you really do not know where the market's going. You can't do any better than your system.
And it sounds to me like when you mentioned that you'd switched to trading longer term, that perhaps that could have been dictated by market dynamics or a change in the market. So how have the markets changed over the years and the impact that had on your trading?
Yeah, I mean, I think in the 90s, we just sort of realized that there were a lot of big trends out there that we weren't capturing and staying in because our systems were shorter term. And that when we did our research, we saw that these longer term systems, 200-day, 300-day moving average type systems, they had a tendency to make a lot of money. And so we adjusted, and the back test proved it out, and performance of since then has proven it out. So we need to subject ourselves to the realities of the back test and not worry about anything else. Now, one of the things I like to do is I have multiple entries, multiple exits. So I'm medium to long term on all of my systems, but I'm diversifying my entries, especially to limit the underperformance of any one particular parameter. But the markets have gotten tougher, they're choppier, they're more trend followers, more computers. So you need to adjust your parameters. And that's what I've done in the framework of the systems that I learned in 1983.
Yeah, so how do you know when you should be looking at adjusting strategy parameters?
Yeah, I think that's a tough one. I sort of head that off by trading multiple methods, trying not to be too short term or too long term, deciding how short term do I want to be and then how long term do I want to be and what are the characteristics of those and the average trade and the average win divided by the average loss, and then I trade everything in between, sort of. So one of the problems is CTAs need lots of sample size on their trades, and I think that's the biggest mistake that everyone makes is the sample size. Um, Having something that worked in the past is much different than a sample size of 5,000 trades from the past. So you really need to concentrate on that. And so it makes it difficult to change systems and sort of identify an approach that is no longer working, quote unquote, because the sample size needs to be so large that the past couple of years is not going to should not influence your thinking of whether this system continues to work. The trades from the 90s or the 80s are just as relevant as the trades of today. Now, I know most people don't agree with that, but this is why you have multiple people on your podcast to get these differences of opinion. But so, and another thing we see too is the systems that we trade, they over a 20, 30-year period, they'll all pretty much make the same amount of money and have very similar characteristics. And then any one year, though, they could have vastly different performance. And then some of them will go in the tank for 3 or 4 years, looking like they're not working anymore, and then come right back to life all of a sudden and be good performers. And, the parameters are very similar. You could have very similar to another set of parameters that have done really well during that same period. So you kind of know that, okay, if I use a 200-day moving average, that has not done very well, but the 220 has done really well. So that should give you some indication that it's just sort of a random thing.
Oh, that's a good way to look at it. Thanks for that advice, Jerry. I'd just like to move on to some questions that have been submitted by listeners. The first one is from Darren, and Darren asks, how does systematic trend follower determine if his drawdown is truly a result of whipsaws in the market or if his system is incompatible?
Well, I don't really, I think that if your underperformance is due to whipsaws, that's not good either. So once again, you need to trade a little longer term. The size of your stop losses that are going to create these whipsaws needs to be sort of optimal to where you're not taking too big of a loss, but you're not getting in and out too quickly. The size of your stop loss is going to be correlated to your percentage of winning trades. So you need to take all of that in consideration. Your trailing stop needs to be not too close to the market. Your stop loss needs to be a certain reasonable distance from the market so you don't keep getting whipsawed in and out. I think all of the choices, entries and exits and markets that you trade, all of this goes into whether your system is performing optimally or if you have an optimal system. And all of these hundreds of details need to be looked at and optimized, or maybe not optimized, not a good word, but made more optimal.
Yeah, sure. Okay. A similar type of question. Actually, we've already covered a little bit of this, but the second part of the question relates to the optimization that you mentioned. So Jesse asks, how often have your trend following program rules and parameters changed over the years? And what best practices do you use to avoid data mining?
Oh yeah, well, we're pretty good at not data mining because we trade a lot of different systems and they don't have a lot of moving parts. I think that one entry, one exit, and a stop loss, that's the answer to data mining. So that's what we have. We never miss a trend. So our one entry gets us in the trade eventually. And the one exit, our trailing stop, will get us out if it, or we'll use the stop loss. So it can't get too much more robust than that. But I think one of the lessons that I've learned is don't tweak very often, because if you're continuing to tweak a lot and frequently, chasing these parameters around, it's sort of similar to not doing the trades. So if you miss a trade and don't follow your system, then everyone agrees that's not right. So if you continue to change your parameters, and in some ways, you're always you're not being very consistent and disciplined, and you're chasing these parameters around only to see your old parameters start to work just fine. And I think that's the downside to um, all of this research that goes on, is that it harms performance sometimes. And sometimes it's just better to stick with it and be disciplined and not try to trade lots of entries and trade lots of exits, and then get rid of that desire to find the one or the couple of different systems that are going to be the best. You can't do it. It's not possible. Find a system, trade systems that keep you in the trend, but don't, try not to give back too much at the end. That's the issue. How do I stay in this choppy market? And yet, when it all does turn around, how do I preserve a good chunk of that profit so as not to give it all back? I mean, that's the puzzle. Figure it out.
Okay, thank you. A question from Ola. How would one measure the health of a system or measure how well the market conditions suit the system?
Well, like I said, I'm not big on thinking that systems go bad and they're good and now they're bad and that sort of stuff. So I just look at maybe my shortest term system. I'm saying, I'm getting bounced out a lot and I'm not sticking with the trends. Maybe I should make my first system a little longer term, or maybe my longer term system, I keep giving back too much profit at the end, and maybe I want to make that a little shorter term. But I'm really hedging my bets by trading everything in between also. So, but I think that when you choose these systems, you need to have a pretty decent 40% plus win percentage. Your average trade needs to be healthy so it can absorb your commissions and your slippage. You don't want that edge to be razor thin. Your average win versus your average loss, 3-1, 2.5-1. I would look at these trade statistics that I've just mentioned, put together a good handful of systems that have these good trade statistics, and then you never know what's going to happen on a daily basis. But it's like going to battle in baseball with guys that hit a lot of home runs and get on base a lot and have a good batting average, and then they go on a 10-game losing streak. Well, I mean, that's just going to happen. But fundamentally, when you look underneath the hood and deep down, you want to have these the trade characteristics. You're not going to get too far if the characteristics of each one of your trades or the average of all your trades is not strong and healthy.
The next question is from MG. MG says, many self-proclaimed pundits have declared the strategy, that's the original model taught in the Turtle program, is no longer effective in today's advanced technology environment. Some have offered the opinion that the Turtle success was more fortuitous timing and luck than repeatable skill. Do you believe the approach in its original structure is still capable of being profitable?
I mean, yes and no. I've already said no in the sense that it was too short term, but 100% yes. I mean, we prove that every day, and 30 years later, that adjusting the parameters for this new world of more trend followers, more traders, more computers, but luck is always a part of it, for sure. Good luck and bad luck, having a drawdown and looking like you don't know what you're doing, and yet you do, and then looking like you know what you're doing, but you really don't. So we've all been in all those situations, and never discount good luck and bad luck. We've had our share of both. But honestly, with the computers and the power and the people that we have, and that almost everyone who's in the trading business has, the knowledge, the experience, we would change in a heartbeat. There's too much money to not be willing to change and be flexible, and there's no reason to stay dogmatic. And I wouldn't if it didn't work. I've changed a few things, but like I said, the fundamental principles of what we do. I think the most important thing we've done over the years is we've probably one of the very few CTAs, even one of the few turtles, who has never done anything except medium to long-term trend following. So right there, most most other managers and CTAs are combining their trend following with mean reversion, pattern recognition, the carry trade, all this other stuff. And we've just continued to try to be an expert and hone in and on our trend following and try to make that as good as possible. And that's been our 100% focus for 30 years. And we're not done. I think being single-mindedly and interested and focused in one particular way of trading is better, at least it's better for me, than being distracted by these other things. So I think my guess is if you looked inside the performance of managers who brag about other strategies that they add to their trend following, the vast majority of the profits that they generate come from the trend following, which is fine because I'm sure clients appreciate positive strategies that smooth out the trend following returns. Just not something I've ever been very interested in, trying to make my trend following less bumpy. But bumpiness is a sign of a robust approach.
Yeah. So do you think that's the main driver for these CTAs to smooth out the equity curve for clients? Is that why they're doing the diversification?
Diversification of the systems. I think they're trying to, and I think it's more psychologically, professionally rewarding also to have a computer and a big research team. And trend following, I guess, is so boring. And golly, we sort of graduated from that stuff, years ago. Doesn't Jerry want something more exciting in life than just continuing to do that? I guess I don't. I guess I'm just built a different way. But yeah, I think it's a good story. Clients like stories, and they like to sort of know that people are changing and growing and adapting, and there's other stuff out there. One of the ways that we have improved approach is adding single stocks. We've trend followed the single stocks using the same systems that we use with our futures markets, and single stocks, allocating your 25% of risk budget for equities to the single stocks gives us far superior performance than using better stock indices that are available. So that I'm all for smoothing things out and making things better, and that's a very big material way that we've done that. It's pretty shocking as these are from a trend following point of view, and how much better your performance can be, and your drawdown will be less if you use the same stocks in place of the indices.
Right, okay. And are there markets where the strategy is significantly less effective now?
I mean, there are just certain markets that hasn't worked that well over the years, but we still trade them, anticipating that they could be good in the future, and that certain markets like wheat and bean oil and cocoa, everyone knows these markets that maybe haven't made money in 30 years. Everyone still trades them, and for diversification purposes, and sort of one of the bedrock principles of trend following is you're supposed to trade all the markets the same and act like that they're the same, and there's no difference between the markets, and you use the same systems and parameters. So you're not supposed to sort of single out any one market as really great or really bad. This is something that is not reliable for the future. Wheat's been bad, cocoa's been bad, but in a systematic approach that has a tendency to have large outlier trades that can change pretty quickly. Cocoa has been a great trend over the past few years.
Okay. I've got a question from Bengt regarding markets as well. Would you say it's a good idea to short equity indexes and bonds? I'm asking because I find them harder to trade on the short side than currencies and commodities.
Well, once again, I don't think it's a good idea to separate into assign characteristics to certain markets or sectors. And when I think about it, it's someone. If I was to hear someone say, I think it's harder to trade on the short side, I would initially think that it's an execution. It's hard to get short. But I think what he's probably saying is that the trends aren't as good, or my systems don't work as well. And I think, yeah, that's sort of the problem with shorts in general, is that they don't make as much money as the longs overall. Then you've just been in a period where every short trade over the past, I don't know, 20 years probably hasn't been that great in those sectors. Once again, that doesn't mean anything for the future. And you just need to close your eyes and do those trades the way the system tells you to do it. You need to choose your systems based upon how they performed on all the markets, longs and shorts, and not single out any sector or market to for a separate parameter, or to de-emphasize it. And like I said, we use a very scientific approach on allocation, risk allocation, 25% for each sector. I mean, where did that come from? It certainly didn't come from research. It's just that, I think every day when I come in, I want to have a very safe portfolio, as safe as it can possibly be. I don't want to rely upon the history and what's been optimal in the past. I don't think that's going to work for the future necessarily. And so I'm going to have the most diversified portfolio I can have. At the same time, my portfolio is going to be dictated by what's trending, what's not trending.
Right, okay, thanks. The next question is from Magnus, and he's actually taking part in a Swedish turtle project. He's currently trying to find his ideal trading method, and he's struggled a lot with his emotions. So he'd like to know, what was your hardest emotional aspect to overcome in your trading career?
Well, I think it was at the very beginning, and just being afraid to do the trades and being afraid to give back profit and wait for that trailing stop. And then that was at a point where we were trading very short term. So think about now, where we're trading long term, and the drawdowns are much larger. So it's really just overcoming, committing yourself to a systematic approach that's been back tested, that's robust, with a few rules, and being willing to do it. And I think every day, it just depends on the structure of your business. If you're sitting in front of a quote machine and the systems are on a piece of paper or they're in your head, then that's difficult. You're going to be questioning yourself and itching to take small profits. And that's the big danger, taking small profits. Whereas now, if you're of an organization with people and computers, and it's much easier because now the trades are created each day by the computer. They're sent to the traders. I'm not a trader, so my traders get the trades from the computer. They have no choice but to do those trades. And so that sort of division of duties is much safer way, a more assured way of making sure that all the trades get done the way they should be, and only those trades get done.
All right, thank you. Two questions here from Michael. Well, the first one you've kind of touched on a little bit already, but I'll ask it again. In your opinion, what was the most important lesson or takeaway from the Turtle program?
Oh, yeah, I've answered that. Do the right thing, follow the system. Trading is hard. It's not easy. Everything has a pro and a con. If you're trading shorter term, if you're taking profits, if you have profit objectives, if you rebalance based on vol, all these things sound good and they have major negatives. So you should not. There's no doing the right thing and making money, taking money out of the markets is hard and difficult. It's certainly not something that should make you feel. It shouldn't be ease, comfort, and pleasure. It should be difficult and psychologically tough to do. But I think I'm very fortunate in that I am susceptible to be going crazy with a good idea and not deviating from it and embracing it and in an absurd, intense way. And so when I was told in 1983 that trend following and diversification and money management and letting your profits run and taking small losses and the biggest problem you'll have is taking small profits, I've spent 30 years sort of like feeling good that I'm one of the few people who really believes this and practices it on a daily basis, and it just gives me more encouragement to continue to do it. If not me, then who? So I'm sort of like wanting to see for myself if a dedication to this sort of idea is going to end up being profitable over a professional lifetime.
And his second question was, what do you think is the biggest misconception about trading out there?
Probably the biggest misconception. Well, one, I think the CTAs who trade a systematic approach, currencies, commodities, stocks, interest rates, long and short, it can't be better, it can't be safer. There's nothing better or safer. Now, I think over the years with high volatility, high leverage, high fees, we sort of screwed it up. But now with the liquid alts and the mutual funds and the CTAs moving into the 40X space, I think that there's a new wave coming where people will see this. And as long as the CTAs keep their leverage low and the target rate of return in the 10 to 15%, low fees, low leverage, lots of diversification, systematic approach, long and short. The CTA should be a core part of everyone's portfolio. Start with that and then see how you can improve upon it with your passive equities or bonds. And then number two, I think, is that somehow systematic is inferior to discretionary. And I think that's the biggest mistake. And that too will change over time, that systematic approach rules computers in not just doing stock only. The stock trends are not superior to the commodity trends or the currency trends or the interest rate trends. It's dangerous to trade stocks only.
And a final question from Rob. He asks, can you share some of the mistakes you've made in the past and what you've learned from them?
Yeah, I mean, not following my system, probably one of the biggest mistakes. Trading too large and too much volatility for myself or for the client. You'll lose clients, and then it'll put a lot of pressure on you to deviate from the system. Drawdowns matter. The size of the drawdown matters. Even though it may be in context with the potential profit, still a 20, 30% drawdown is going to put you in a highly likely situation of not being able to follow your system and losing clients. So I think trade small, follow your system. Those are the two most important things.
Okay, that's great advice. Thanks. When you hire traders for your CTA, what do you look for? Do you follow any of the same processes that Richard Dennis used to find the turtles?
Well, I think that no, because all we were looking for with the traders that we hire is to be able to sort of do admin and execute the trades the way that the computer wants them, done at the time and at the price. So I think today's turtle program would be not so much hiring people like me, but would be hiring people who were good at computers and math and programming and sort of able to develop systems and do the back test. And so we were sort of given the ideas and given the systems and told to go for it and be disciplined and maybe try to, over time, think of ways to add value. But I think today's turtle program needs to be more of how do you create systems, come up with different ideas on identifying trend and identifying the end of trends and things like that. So I don't think I would be qualified for a 2015 turtle trading program.
Cool. All right. Well, thanks a lot for that, Jerry. Just like to wrap it up now. So is there anything else that you'd like to mention before we close up?
Oh, wow. I feel like I've talked so much, I can't think of anything to say. I will once we hang up, but
Yeah, sure.
you'll need to bail me out here.
Oh, okay. Well, we usually finish off with a couple of quick closing questions. You've kind of addressed them all mostly, but I can ask you a few if you like.
Okay.
Biggest lesson you've learnt through trading?
Do all the trades and be systematic. Don't trade too large. I feel like I've repeated that a few times, but don't desire the approval of others. One of the things that was taught in the turtle trading that's been lost over the years, at least when I hear about the turtles is sort of a contrary opinion point of view. If be don't desire, try to fade the news. Go with the trend, and if the news or the sentiment is negative and the market is going up, welcome that idea. One of the cliches over the years is, the best trades are the ones where the fundamentals and technicals agree, and I would say that's sort of the opposite. If you want the fundamentals or the sort of the popular news to be different than the trend. So I think that's a little nugget of wisdom that if you're a systematic computerized CTA, you're probably not including that in your trading. But if you're having fun trading your own money, add a little bit extra to your position if, depending upon the sentiment or the news at the time.
Okay. And do you have a favorite trading book or books?
Well, I started out, I got my introduction to trend following with Martin Zweig, Winning on Wall Street. And so that's a special place for me. But then the Jack Schwager books are really good. Anytime you can read interviews of famous traders and learn a little bit from them and see what's important to them. I think the secret Wall Street formula for survival is diversification, respect the trend, and take small losses. And I think if you dig deep enough, you'll sort of hear those themes from a lot of people who have survived over the years. Be flexible, respect the market. The S&P hit a 200-day low in January 2008. So anybody who just respect that as a place to be defensive or be flat or be worried, I think a lot of the times the market does give you an opportunity to get out of the way of a bad thing if you sort of pay attention to the price trends.
And a final question, what's the best way for listeners to get in touch with you?
Well, I would just say go to ChesapeakeCapital.com. We have information out there, and I'm on Twitter at RJ Parker Jr. 09. So I'm out there and easy to find, pretty sure.
Okay, great. Well, thanks for your time today, Jerry. It's been very insightful and an honor to speak with you. So all the best, and thanks for your time today.
My pleasure. Thank you very much.
All right, cheers. Bye-bye.
Bye.
What a great chat with Jerry this week. Here are some of my favourite points. Firstly, his focus on trend following. He has one particular style he trades, and his focus is on being the best at that. He's resisted the urge to diversify into different styles. His diversification is actually across markets and entry and exit conditions instead, and he's done very well at specializing in one particular style. I also enjoyed his solution to optimization or data mining. Jerry said, I don't want to rely on what's been optimal in the past, and the way he gets around that? Well, he trades lots of different entries and exits to remove the desire to find the best. He's chasing trends and has shorter and longer term methods to getting in and out to ensure that he doesn't miss a trend. And the final point, which comes up all the time, is around discipline. We always hear follow the system. If it says to enter and exit a trade, just do it. Jerry summed it up very nicely in the statement, you weren't wrong if you took a loss, you weren't right if you made money, you just followed the system. If you want to get more information about this week's episode, head over to the show notes at bettersystemtrader.com/17. We have links to additional content if you'd like to know more about Jerry. Also, a big thank you to all the listeners who submitted questions for Jerry this week. If you'd like to submit a question for future guests, make sure you're on the Better System Trader mailing list, and I'll send you an email when the next opportunity arises. Next week, we have a chat with Scott Andrews, the Gap Guy, about gaps and a bunch of other trading topics. It's a great episode, so make sure you don't miss that one. Anyway, that's it for this week. I hope you enjoyed the chat with Jerry Parker. Thanks for listening to Better System Trader, and I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.